Hi, I'm Ed Harrison here in Toronto for Real Vision. I'm talking to Jim Keohane, who's the president and CEO of the Healthcare of Ontario Pension Plan. Jim, it's great to have you.
Oh, thanks for having me, Ed.
You know, so I think when I spoke to you yesterday about this interview, and what I was telling you is that our co-founder and CEO, Raoul Pal, he has a big issue with regard to retirement. And I think it's driven from a personal perspective. He saw what happened to his father's pensions in 2008 and his savings, and he really thinks that this is a big issue, especially from a demographic perspective, and that in terms of the democratization of financial information, which he's a big advocate of, he wants to start a series talking about, best practices in the industry, Canada being a place where they have them, and what we can do to make our retirements better. So, before we get into all of that, let me ask you about your own personal career, because you are about to retire next month as CEO and president. Yeah. And you've been at the company now for over 20 years. Tell me about the transition from where you were, which was Merrill Lynch and Wall Street banking, to the pension company.
Yeah, so actually I worked at several Wall Street firms, Merrill Lynch being one of them, but actually the last one was Deutsche Bank, which you mentioned.
Oh, yeah.
You worked there yourself. But, I had an opportunity to come to the pension plan, and at the time I could see a few things. I mean, there was a shift I think in power from the dealers. You could see the pension funds are getting very large pools of capital, and that's where the kind of where you wanted to be. But also there's a big difference in me in terms of, I found that since I've got there. I mean, when you work at an investment banks, I was doing proprietary trading, which today would be done in the hedge fund world. So,
right.
When you worked at an investment bank, you're kind of as good as your last trade. And so, if you had a good trade, you'd continue to work there. If you didn't, maybe they'd show you the door. But there was no loyalty given to the employees, and the employees showed no loyalty to the employer, and so it's a bit of a toxic environment. And what it was all about was, if I make a certain amount of money, I'm going to get a percentage of my pocket, and that was as far as it went. So it really didn't. After a while, it doesn't get you out of bed in the morning.
Right.
It doesn't really motivate you to continue to work. Whereas when I got to HOOPP, it was a very different environment in the sense of what we do really makes a difference in people's lives, and it's very tangible when you actually meet the pensioners in particular. I mean, they're extremely thankful that they've been in the plan, and they're very grateful for what we do for them. So we allow them to, retire in dignity with a stable financial future going forward. So people are extremely appreciative of that. So it's, effectively, it's, so what we do, I think, is very important to our members, and it's very important to society. So that really is a good motivator to get you to come in and do your job every day as well as you can, because it does make a big difference to those people.
Yeah, and what you're saying reminds me that we should definitely talk about defined benefit versus defined contribution here, because that's a big part of it in terms of giving people sort of a safety net. This is how much income I'm going to get, irrespective of how long I live for the rest of my life.
Yeah, so I mean, most individuals, no question, are better off in defined benefit plans. I mean, because they, for a whole bunch of reasons, but I mean, the challenge has been, it's been difficult for employers to stay in defined benefit plans because there is a changing environment. We have low interest rates, we have people living much longer, so it's it is more difficult to actually manage these plans and keep them going. So.
We were talking earlier before the interview about your transition. And one of the places where you can make a difference is in terms of fees. And it's interesting in terms of how a pension plan can deal with costs. And we were talking in particular about Nortel Networks. They were 37% of the TSX, the Toronto Stock Exchange Index, and huge outsized risk for HOOPP at the time. But you were able to manage that risk in a very positive way. You gave me a big number of $800 million, $850 million. Talk me through that episode when Nortel had tanked during the tech bust.
Sure. So we're a very big user of derivatives, one of the largest in the world, actually. And most people are scared of derivatives, but they're actually very, if you use them properly, they're very powerful risk management tools. And I think we're a very sophisticated user of derivatives. But so what we did at the time, Nortel became this disproportionate weight in the index, and at that time we had a bunch of outside managers as well. So when you start drilling down on all these portfolios, they all had Nortel in it. And so what we did is we did sort of an overlay on top of the thing using derivatives. So I was charged with sort of trying to keep our exposure below 5% of the fund. And so I used what we call a costless collar to do that transaction, which is effectively buying put options for if you like to sell a stock at a fixed price for a period of time. And then to pay for that, we sold call options, which about 15% above the market, which would cause you to actually force you to sell the stock if it went up by more than 15%. So it effectively capped our exposure within a range. And we did that in very material size because of the size of the exposure we had. And so I think it was around 2000, Nortel warned, and the stock went down, I don't know, 30% in one day.
Right.
And so in that one day, that offset gained us about $850 million. So
$850 million, right?
Yeah,
And the thing is what you're talking about is reducing the volatility. That you still have exposure, but you're capping upside and downside, and that's part of the profile that you're talking about in terms of risk. This is something that you can do that individuals can't do. That's something that we're going to be talking about going forward.
Yeah, so individuals just wouldn't have the credit worthiness to do strategies like that. We're because of our size, we're extremely creditworthy counterparty. So, Wall Street banks are very willing to deal with us, knowing that if when it comes time to pay, we'll pay. And so, whereas individuals, they would never do that strategy with because people can go bankrupt and they can't get the money from them.
So how have you changed HOOPP, and how has the pension industry in Canada in particular changed in the time when you first came in 1999 to now when you're leaving?
So there's a few big things. I mean, we've pretty much insourced all of our activities. So we have our own in-house pension investment management staff that runs virtually all of the money. We still have some partnerships outside, but most of the money is run directly by our own staff. And that has huge advantages in the sense of it's much more cost effective.
Right.
So paying people to run money for you is significantly more expensive. And just to give you an example of that, when I first became the chief investment officer, we had about 15% of our money run externally, and when I insourced that, so that 15% cost more to run than the other 85. And actually the returns were not as good. And one of the other intangibles is that you sort of sacrifice control of your risk management because when you give money out to other people, they're going to do what they want with it, and your choice is you can take your money back or leave it with them. And so whereas internally, we can, if we're not comfortable with the market, we can dial the risk up and down quite easily.
And you say 15 was more expensive than 85.
That's right.
That's astounding. I mean, because that again, when one of the key things, we'll talk about your the framework of how you look at the pension industry. But one of the things that I thought was extraordinary is about the cost versus an individual. I mean, that is a cost savings that you can't make as an individual if you're investing on your own.
Yeah, so our investment costs are about 20 basis points or 0.2% per year. Mm-hmm. And when we looked into what individuals pay, and it's typically somewhere between 2 and 3% per year, so 10 times as much.
Right.
And that difference of 180 basis points, I mean, it doesn't sound that much annually, but you start compounding that over 40 years, and you actually end up with half as much money.
Right.
When I first saw that, I thought, that can't be right. And I did the calculation myself, and in fact, that is true.
Right. The magic of compound interest, yeah.
It does make a huge difference over time.
And what other things have you seen? Because I think that the industry's changed a lot. I mean, essentially, you came in from an industry, you brought your expertise. My sense is that in order to have people of that capability, you have to pay them the going rate. What sort of staff do you have in terms of trading and risk management and things of that nature?
Yeah, I mean, we really have top-notch staff. I mean, we're really some of the best people in the world, and we pay them market rates. And I think that's one of the big challenges that the U.S. funds have is the governance structures don't allow them to do that. So there's some very large pools of capital in the U.S. that could be run the way we run our money. All in-house staff. But the structure of most U.S. plans is not independent. I mean, it's a lot. If you look at a lot of the state plans, they have politicians sitting on their boards and stuff, and it's politically unacceptable to pay people in-house a check. Yet they'll write a check to an outside manager that's 10 times as much because it's kind of depoliticizes the payment.
You mentioned governance. It actually reminds me that we have. I was looking at your website, and you talk about advocacy at HOOPP, and there were 5 drivers of that. And I think maybe this is a good framework for thinking about this conversation.
Yeah.
The 5 drivers you talked about were savings, fees and costs, which we already mentioned, investment discipline, fiduciary governance, which is what you were just mentioning, and then risk pooling. I want to go through those one by one and then sort of get a sense of how much that makes a difference in terms of how much I, as an individual, need to save if I were to be with a defined benefit plan like HOOPP versus if I were trying to replicate that on my own.
Yeah.
So let's talk about the savings and how people save and why that's one of the 5.
So one of the big items actually is savings patterns and what we see. So if you're in our plan, it's taken off your paycheck every 2 weeks, and it's automatically goes. So people don't even notice it. So that's what they just live off their take-home pay, and it's automatically taken off it, and they don't have to think about it. And the other thing is it's locked in. You can't take it out.
Right.
What we see in individuals trying to do it on their own is it becomes an afterthought. They're dealing with their kids' education, cars, paying for their house, and at the end of it, do I have any money left to save? Well, if I do, I'll put some aside. And here we have an instrument called a registered retirement savings plan, which would be similar to your IRAs, right? Mm-hmm. So the IRA, so the deadline's February 28th. People rush in February 27th to the bank and put whatever it is and buy the flavor of the day, right? So so it's not no real thought given to what you should do with the money, and they put in whatever they happen to have at the time, which is usually very inadequate to provide you with a decent pension. And the other thing you see is that when they have a crisis, a financial crisis in your life, that they withdraw the money. So it's interesting when you look at the stats that the people that have been in individual savings accounts. I mean, most of them have absolutely no money at time of retirement. So it's not just they don't save enough; they don't save at all.
Right.
And so people get to unless people are in workplace pension plans, they just and that can be it doesn't necessarily have to be a DB plan, but if in a workplace pension savings vehicle, they don't save at all.
Right.
And so And unfortunately, what we've seen in the last few years is this trend away from workplace savings plans, and we need to think about ways to sort of stem that tide and move things back in the other direction.
Even though I want to go through these stepwise, when you mention the fact that we've seen this move away, the immediate thing that I think about is what you told me about the accounting issues and why this happens. I mean, I want to go straight to sort of the solutions thing here, because basically, the solution is defined benefit, is my understanding, and what we're already talking about in terms of savings on a regular basis. But the reality is that in a private company, it's not on an accounting basis a good thing to have that on your balance sheet. Like you mentioned GM in particular as an example of that.
Yeah. So, and this goes back to the Sarbanes-Oxley legislation, which happened after the Enron and WorldCom bankruptcies, where they had all these off-balance sheet entities that masked a bunch of risk that was there. And so, that legislation essentially said you had to put all these things back on your balance sheet, which included the defined benefit plan. So in the past, the defined benefit plan was kind of a one line in there. It was off the balance sheet. But, just if you get swings in interest rates, you can get very material swings. You've got, 50-year assets there that, very small changes in interest rates, for example, can change the value of it a lot. So once you get that back on the balance sheet in the earnings statements, it creates a huge amount of noise. And so companies have big pension plans, and GM is an example of that. I mean, I think the pension fund's about 5 times the size of the company. the pension plan affects the earnings more than anything, and so the kind of the joke in the financial markets is that GM's a pension plan that makes cars, and it's true in a sense, So, if I put my investor hat on and I want to invest in a car company, I look at GM and think, I'm going to get too much exposure to this pension assets, so I'm going to go buy some other car company instead. So there's a huge amount of pressure from shareholders for GM to get out of the pension business.
Right.
And so that's where it comes from. If the accounting was not that, if you went back to the previous accounting, that probably would alleviate that issue. But employers are looking to have defined contribution accounting. In other words, all they have to put in their earnings statement is the contribution they make in the employee's account that year, and then any future risk is the employee's issue. Right. So the risk doesn't go away. It's just got shifted off the company's book to the employee's book.
You use defined contribution accounting, though.
Yes, our employers do. The reason is HOOPP is a different structure. So we don't just manage the money on behalf of the employers. The obligation for the pension is actually HOOPP's obligation, not the hospital's obligation. Mm-hmm. So effectively, we don't only take on the management of the money, we actually have the pension is guaranteed by HOOPP. It's not guaranteed by the hospital.
Right.
So from the hospital's point of view, they really just make a contribution into the plan. And the only future obligation they could have is we could raise the contribution rates.
Right.
But they have no obligation in the future to fund, like if we had got into a situation where we're underfunded or something, they have no future obligation that way. So their accounting is DC accounting. So our structure actually is an interesting structure that could be brought into the private sector that may encourage people employers to get back into something that looks more like a defined benefit plan.
And so you're talking about governance right there. So let's unpack that a little bit, because we have on the one hand the fact that you can have your constituents have defined contribution accounting, and that takes away this whole accounting issue. But at the same time, they have no control over the governance of how the plan works. How do you achieve that?
Well, they do some control in the sense of our board is constructed of the trust. So HOOPP is a trust, mm-hmm. And so it was originally created by an agreement between the Ontario Hospital Association, the employer, and 4 founding unions, which is OPSU, QP, OPSU is Ontario Public Service Employees Union, Canadian Union of Public Employees, SEIU, Service Employees International Union, and Ontario Nurses Association. So that's the 5 founders of the trust. And so the employer side appoints 8 board members, and each of the unions appoint 2. So it's kind of half union, half management, if you will, at the board table. So they do have some level of control over it. Trust law requires, though, that they all check their hats at the door and they do things that are in the interest of the members of the trust.
And who are these individuals in terms of their competence as from a financial perspective? What do they do? What is their knowledge about pensions and things of that nature? So
it's mixed. So we have some people that I would consider financial experts on the board. Mm-hmm. And some people that are senior members of the unions, for example. But it's a good mix, because essentially, the union people represent the interests of the members, and so you get to understand the members, things from the members' point of view. And plus, we have some financial experts that sit on the board that can provide expertise at the table. And we also have hospital CEOs, for example, on the board that that represent the interests of the employers. So there's a good mix there, and it does lead to good decision making. So I think most people would call our board a lay board. Mm-hmm. I think that's a bit of a misnomer, because they're all very intelligent people, well educated, and their day job is, in a lot of cases, not in the financial services sector, but a lot of them have been on the board for a long time. They're familiar with the issues. They're up to speed, and so it's not. And the decisions do get made in the best interest of the members of the plan. So it all works. And you'd think that maybe you'd have all the unions lay up on one side of the table and management on the other side. That's never happened. So we have a dispute resolution mechanism that's never used. It's never been close to being used. So people do actually act very much in the interest of the members. And I say to people, if you were a fly on the wall in our board meeting, I think you'd have trouble telling who is the union rep and who is the management rep which is how it should work.
Right. And you know, the key for me in terms of that is the ability for these hospitals, even though they're not necessarily publicly traded companies, to use defined benefit, or defined contribution accounting, because legitimately, if you take that issue away, then the opportunity for private companies to use defined benefit solutions increases. Instead of what you were saying, that we're actually moving away from that, you could actually have people move towards that because suddenly they can offer that to their employees, and that's a safety net that people would want.
Yeah, no, so it's just again, moves you away from the sort of, we're trending very much more towards individual managing their own plan, when it's much more effective to have collective plans, and that you want to try and move the trend back in that direction.
With regard to the governance, what other factors within the governance, I'm thinking of it from the Canadian model, are different than, say, governance in the United States?
Yeah, I think just we in fact, you're allowed to run our pension plan like a business, and I think a lot of the cases in the U.S. they get used as instruments of public policy. So we are completely independent of the government. The government doesn't appoint any of our trustees, and they're an important stakeholder, obviously, but we don't. They really have been pretty hands off, and that's pretty true of all the major Canadian plans as well, which has been very effective, and it's allowed us to get into areas that I think other pension funds have had trouble doing. So we've been early movers on use of derivatives, for example. We're early movers on, in our case, using a liability-driven investment approach. Some of our peers have been very early adopters of infrastructure. And we're also have been early movers in private equity as well. So that model of better governance has allowed things to be done that work well for the members, and so that's always sort of the top of mind consideration in terms of what you're doing things, and so the political interference is not there. And going back to the issue of pay, for example, it's way cheaper for us to pay internal staff, and we can actually run the plan much more effectively with internal staff rather than outsourcing. And so there's a bunch of activities we can do in an in-source environment you just couldn't do in an outsourced environment. So so it allows us to run the plans much more effectively when we don't get this sort of political interference.
In that response that you just had, you mentioned something about what I would call the third plank of the five that you went down, investment discipline, because you were talking about liability-driven investing. And there were some other things that you talked about. I want to talk about what you're able to do that individuals aren't able to do. And in particular, I'm thinking about your asset allocation mix, as well as some of the other things that you were talking about. What sort of, as you think about when you got into the business in '99 versus now, what's happened in terms of the asset allocation mix, and how is it different than, say, I as an individual would be able to invest?
Well, just an example. We went through this exercise after the 2000 to 2000 after the tech meltdown, and we went very quickly from having a surplus to a deficit. And when we unpacked that, we could see that, first of all, there was way more risk in the portfolio than we thought. And we had the traditional sort of 60-40 equity bond portfolio at the time. Most of the risk came from mismatch between assets and liabilities. So we had a situation there where interest rates went down, so our liabilities went up, and our assets went down. So it was kind of the perfect storm. And at that time, it was kind of accepted that that's just the risk of being in the pension business. And I thought, well, surely we can manage that more effectively. And so we started thinking about ways to better align our assets and liabilities to sort of take away some of those major risks. And our previous exposure with derivatives really allowed us to think about the portfolio in very different ways. And derivatives allow you to sort of break the portfolio down to its component parts. So think about the capital asset pricing model, which sort of risk-free plus beta plus alpha. So risk-free for us is essentially long-term bonds. beta is, whatever exposure risky assets you want to get, which you can achieve through use of derivatives, and alpha is just your active management strategy. So the two biggest risks probably most pension funds have is actually equity market exposure and interest rate risk, and those things come from moving to having equities in your portfolio. So if you think about the least risky position we could have is owning bonds, right? But that doesn't produce enough income to actually, the plan will be unaffordable if that's what you have. So if you don't use derivatives, the only way you can get exposure to equities is actually to sell your bonds and to buy equities. So you not only do you take on equity exposure, you actually create a big interest rate mismatch. So if you use derivatives, you can actually do an overlay, so you can leave your money in bonds and then just do equity overlay on top of that. So using interest rate futures, equity futures swaps or options. So that enables. So that's essentially what our portfolio structure is. We have a whole bunch of interest rate sensitive and inflation sensitive assets that hedge our liabilities much more effectively, and then we take on other risks in an incremental way using derivatives to gain those exposures. So that combination is actually less risky than if you had a traditional portfolio. So that's an example of things that we can do that you could not do on your own.
Definitely. And what about the alpha component of that mix? Because I know that that mix that you're talking about, it gives you less volatility, but I think you also said that there's more upside as well. You have almost the best of both worlds.
In fact, what we've done is, so there's three big risks which you're trying to hedge, which is inflation risk, interest rate risk, and equity market risk. So we're trying to control those risks more effectively, and then we're trying to take other risks that are maybe more quantifiable, that if the worst case scenario plays out, it doesn't actually have a catastrophic impact on the plan, whereas those other risks actually would.
Right.
So we enter in a whole bunch of absolute return strategies, which typically would be used in a hedge fund world. So we'll do equity long shorts, credit long shorts, funding trades, and we have a list of about 20 or 30 different things that we'll work on, and we may not have all of them active at any point in time, but it's a diversified portfolio of absolute return strategies. So those strategies themselves actually produce enough return that enables us to take our equity market risk down and still achieve the same level of return. So our equity market exposure is about 35% of the portfolio. Well, most people, it's more like 60 or 70.
Right.
So if we had a big equity down market next year, we wouldn't lose anywhere near what our peers would lose. Now in a big up year, they're going to do better than us, but we're okay with that.
Right.
So it's intentionally making that trade-off.
And that goes to the conversation that we were having just before the cameras rolled. This is also another aside away from the five structure, because right now what we're seeing, we were talking about the coronavirus and we were talking about risk. And the question I had for you as someone who's in the business is, how is it possible that equity markets continue to go up almost more now, and the macro risks are greater? It's not just the coronavirus. It's also the fact that you look at global growth in general. You look at the PMIs that came out of Europe as an example. Very negative industrial production numbers, even in December before the coronavirus hit. So how is it that equities, the DAX as an example, all-time high? I don't understand how that's how people are doing that, and what's going to happen to those markets when bad things happen.
Well, yeah, I scratched my head a bit on that too, but I've seen that before. If you go back to 2007, and we're involved in all these markets, so we could see it going on. The credit crisis was well underway 6 months before the market peaked. It was all there for you to see, and the market sort of completely ignored it for a period of time. And so it's interesting. My observation over time is that markets, when they got momentum, can go a lot higher than you think they're going to go, and they tend to ignore facts when it suits them.
Right.
And we may be in one of those periods right now where, if you look back a couple of years from now, you think, what were people thinking about? Because if you look back in 2010 at what was going on at that point, you would have thought, like, why didn't people see that? And,
Right.
so I think there's a bit of that now, and I think people think it's a blip, that it's just, we're going to look through and it's going to, everything's going to be fine. And central
Right.
banks have the ability to manage all these things, which, I think if you look at previous periods before the last 10 years, I mean, you can see there's lots of things where the central banks can't manage that. Again, it's a bit surprising, but it's not. I've seen that. It's that pattern I've seen before.
And so, I mean, that's why you're taking the position that you are in terms of, capping or giving away a little bit of the upside in order to deal with the downside. I mean, the view that I have is that the downside risk, when you look at those kinds of factors, could be larger than people might think. That is that when you think about the fact that we haven't really had a 20% pullback, and when you think about the fact that these macro risks are out there and the markets are still going, you could have a very sharp drop in the market. And if that were to occur, it goes to a concept that I think that you were talking about in terms of wrong way risk. Talk to me about what that means in terms of pension companies, how they manage those downturns.
So, you mentioned the wrong way risk. The wrong way risk is, in other words, if the market goes down, you're going to do worse. So I would describe the risk profile of a pension plan as a non-linear risk utility. And what I mean by that is that a loss is way more damaging than a gain is beneficial. So, if I gained 25%, it's not as beneficial as a 25% loss is damaging. And so why that's true is, so if you go back to 2008, a lot of funds did have 25% losses. And so today, if we were fully funded, we had 100% of the assets we needed. We need to earn about 6% to keep the thing on an even keel. So if we not lose 25%, we now only have 75% of the assets to produce that same level of income. So we need to earn 8 on those assets. And plus, because we now only have 75% of the assets we had before, we need to earn 33% to get back to where we were. So it's a bit of a slippery slope. And we've done modeling, and you can see that there's a certain tipping point you get to that you can't recover from it. So so there's this kind of an implicit assumption in the way pension funds are run, that if you have this long-term time horizon, that equity market risk can get absorbed and you're going to be fine. Our modeling shows that you can go through these periods where you get to a position where you can't recover from it.
Right.
So I think there's a tipping point, which is probably somewhere between 60 to 70% funded, that the returns you need to earn to get back to a fully funded status are impossible to actually achieve. So what you want to do is make sure that you never get on that slippery slope. And so that's why we've constructed our portfolio where we've constructed it. So, we're prepared to give away some of the upside to keep us from having that downside. And so it just effectively reduces our volatility and never is going to get us in that position where we're not going to be able to recover from a big downturn. And we're very conscious of that all the time.
Right. And since we're talking about asset allocation in general, that's where I started on this. You told me that you actually have a decent amount of real estate in Toronto, also in DC, where I'm based. Asset allocation-wise, what's the breakdown? You talked about 60-40 when you first came into the business. How would you break that down today in terms of alternative assets like that, real estate, private investment, and things of that nature?
Yeah, so we have about 15% of our assets in real estate. And real estate we consider a matching asset because that has very good inflation hedging characteristics. And plus it produces good income. We have about 15% in private assets, private equity, private credit. And we have about 15% in public equities. And the rest of it is in long-term fixed income, and real return bonds, which is in Canada we call them, it'd be equivalent to tips, and we do own some tips. So we have inflation hedging asset, which is real estate and real return bonds, and then we have, so most of our should start over. So we actually broken our portfolio down to kind of 2 components, which is an inflation hedging portfolio and a return seeking portfolio. So the inflation hedging portfolio contains real estate, real return bonds, and long-term interest rate bonds, all governments. And we also have a small infrastructure component right now we just started. Then we have so again, that portfolio would probably produce in today's world about a 3 to 4% return. We need to earn 6, so we need to earn another 200 basis points from other activities. So that's where we have we overlay on top of that exposure to equities using equity index future swaps or options. We have exposure to credit using credit default swaps. So we sell credit protection on the investment grade index to get our credit exposure. And then we have a whole suite of absolute return strategies. And so that combination creates our overall asset mix. So it's hard to describe our portfolio in the traditional way.
Right, yes.
But it's because it adds up to more than 100.
Right.
But that's the structure of the portfolio.
Well, as you were talking about inflation, and I was thinking about the drop in market. One of the things that, in terms of the underfunded position of pensions that I found interesting was this concept that in the board managed structure that you have, there's the opportunity to deal with COLA in a way that gives you some catch up. And that's also another, I would call, right way risk type of structure. Can you explain how that works?
Sure. So our board intends to pay inflation protection on pension payments. So our objective is to try and pay people 100% of CPI every year as an adjustment on their pension. And we've been able to do that most of the time. But the board has, so it's ad hoc though. In other words, the board will only give you that if we have sufficient funding to do so. If we got into a period where we became underfunded, if we took that from, our modeling shows that we took that from 100% of CPI to 0, that would improve our funded position by about 20%. So that's a big lever that really allows you to go through a lot of different downturns and manage through risk. And we model these things most of the time if that's all you would need to deal with in order to keep our funded status sufficient to meet the obligations. So it's a very powerful lever, and a lot of the funds here have that. The trade-off I would tell members on that one is that our price is pretty relative, is one of the lowest of all the major funds here. So members pay roughly about 8% of their compensation or their salary for the plan, and we can keep it affordable like that because of features like that. So the alternative is we could give you guaranteed COLA, but we'd have to charge you 12. So if you give people that trade-off, they'll say, and so the risk is to you is that when you're retired, there may be periods where we have to lower your inflation protection, but when we get sufficient funding, we'll give it back to you. So and we've done that a couple of times. We've never taken it to 0, but we've taken it to 75% of CPI a couple of times. And once we had sufficient funding, we brought it back to 100 and actually made people whole back to where they would have been. So it's a very effective tool to enable us to manage through difficult periods and keep the fund going. So again, it surprises people when you find out how effective a tool that actually is.
When you mentioned that example, by the way, it reminded me of the advocacy part that you have on the website, which breaks down into those 5 components. It talks about how much money you could save, how much money you could put in if you were to put it into a HOOPP versus if you did it on your own. And the number that I saw was something like $900,000 extra that you would have to save on your own. Yeah. Walk me through that math, because I think that's pretty extraordinary.
Yeah, so what we did is we created a theoretical pensioner, and it was because we're a healthcare organization, it was a nurse. And so our nurse, Sophia, we assumed that she started her career at age 25, earning about $40,000 a year and got the usual escalation through her career, and that she retired at age 65 and wanted to replace roughly 7% of her income, which is kind of what our plan does. So if you go through what you need to do, and this, so that's where we looked at these 5 factors: savings patterns, investment acumen, governance alignment, management of the accumulation phase, risk sharing, and I'm missing one.
Savings, fees and costs.
Yeah. So when you look at all those things, And the two biggest ones are actually fees and costs and management of longevity risk. Those things result in, if you're an individual, you'd have to put aside about, the correct number, I think it's about $1.2 million over your career to actually achieve that outcome for that particular individual, which, by the way, is almost impossible given the income level. But if you did it through HOOPP, you'd have to put aside about $320,000, I think is the right number. So it's about a $900,000 difference between what it would cost you to produce exactly the same outcome on your own that you could produce within a pool plan like HOOPP. So it's much more efficient way to actually achieve the same outcome.
And you guys are, I mean, from my perspective, you're totally underselling the differential because, I mean, you say 900,000, but you don't show the actual numbers. 320 versus 1.2 is like a ridiculous transformation. I mean, you're talking about almost 4 times as much that you would have to put away in order to replicate that on your own.
Yeah, and you know, the reality is most people just don't have that kind of money to do that. So, I mean, it's not even a matter whether if you wanted to, you probably don't have sufficient funds to actually do that. So it's, but that's the equivalent number.
And you know, the thing is, and we talked about this yesterday when we were talking about the interview, that I think, and you know, Jim Leach, when I spoke to him, and Ramsey Smith, who you also know, when I spoke to him, they both mentioned this mortality risk pooling. Yeah. You said that risk pooling and fees were the 2 biggest things, and we haven't talked about risk pooling at all. But tell me, where does the big savings come in there?
There's a couple of things there, actually. I mean, the first is, well, there's 3 places where you get big risk pooling benefits. The first is, you know, if you were an individual and retiring, think you're going to retire in 2008, you may have had a 40% drawdown on your funds. So you either have to take a much lower income during your retirement, or you have to postpone your retirement activity. If you're in our plan, that risk gets absorbed across generations. So people who retired in 2008 got the same as they were expecting, and it worked out fine. Second place is that if you're on your own and you retire at 65, you got this chunk of money. It's got to last the rest of your life. So you can't take a loss, or you may find yourself in a very difficult position. So you have to actually dial your risk down. So you have to take a much higher fixed income component in your portfolio than you would otherwise have.
Yes.
So that actually reduces your return over, which could be a very long period of time, 20, 30 years. Whereas in our plan, again, because that's absorbed across generations, we can maintain the same asset mix all the way through that period, so we can maintain the return. So again, that makes a big difference. The third place is longevity pooling. And so, if you think of a large plan like ours, we have 380,000 members in the plan, so average mortality becomes pretty predictable. So in our case, it's about people who live to 65. The average mortality is in our plan is about 87. So we know we have to pay people for roughly 22 years, and we can charge people based on that, and so we can charge you less through your working career because we know that outcome is pretty predictable. Whereas if you're an individual, but within our plan, we some people pass away shortly after retirement, but a lot of people live a very long time too. So we have members in our plan. Our oldest member is 104. And she actually retired in 1976, by the way, so she got a pretty good deal.
Yeah.
But we actually have 72 members that are over 100, and we have 2,500 between 90 and 100. So, people can live a long time. So you, as an individual, you kind of have to assume you're one of those people, because you don't want to run out of money when you're 90, right?
You don't want to be eating cat food at the age of 90.
Right. So in our plan, you're going to get paid for your entire life because that risk is shared across the membership. Whereas you as an individual, you either have to save a lot more money to get the same outcome, or you have to take a lot less money in your retirement in order to make sure it lasts through your career. So just that, even if you assume, you're going to live 5 years longer than the average, I mean, that's a lot of money.
That is a lot. And of those 2 outcomes, the second one is the one that gets me. You say you could either save more money or reduce your expenditure once you actually retire, because that has huge public policy implications. I mean, the whole concept, when you're going from defined benefit to defined contribution, basically what happens is all of the risk is larded onto the individual, and that individual changes their behavior. And that change is one that actually reduces consumption. It reduces growth in the economy.
Yeah, and so we had a study done a few years ago. It was done by Boston Consulting Group for us, and it was the objective of the study was actually to look at how the distributions from defined benefit plans have impacted local economies. And one of the interesting things that came back out of that study, I mean, they weren't looking for this, but that's what they found, is that there's a very different spending pattern between people that were in defined benefit plans and had predictable income versus people that were not. And so people that were not generally hadn't saved enough during the working career, so became savers in retirement.
Right.
And they're all worried about outliving their money, and there was no predictability as to what the next check's going to be, right? So so they became savers in retirement. Versus people that were in defined benefit plans knew they were going to get a check next month, so spent the money. And so, had this sort of, one has a dampening effect on the economy, the other has a stimulating effect on the economy. But even if you go back to, what we just talked about, that difference between in the working career, putting aside $1.2 million versus putting aside $300,000, I mean, that puts $900,000 back in that person's pocket during their working career they can spend on other things, right?
Right.
So again, it's stimulative impact on the economy. So, so I mean, I think there's that seems to get lost a bit in the fact that there are a lot of economic benefits to people having predictable income and again, not taking as much away from them during their working career. So efficiency makes a big difference.
Oh yeah, definitely. And I mean, I guess we've gotten to the solutions part. I feel like we've gone through all 5 of the different parts where that you were talking about. So I feel like we should talk about, now that you're on the verge of retirement, what your, when you think about your legacy and what you can tell people about what needs to be done for the future. What are your takeaways? I mean, one of the big takeaways for me is that defined benefit is good. Yeah.
So defined benefit, or I mean, I think in today's vernacular, you wouldn't call HOOPP a pure defined benefit plan. It's pretty a target benefit plan.
And tell me what's the difference between those two?
So the difference is, I mean, if we our objective is to meet that pension obligation to the member, and that's very much ingrained in our DNA and in the organization. But if that didn't happen, I mean, you'd have to do things like adjust the COLA, or if it got worse than that, you may have to actually reduce people's benefits. I mean, we don't want to do that, but it's possible that could happen in a really extreme negative scenario. So that's why we try to make sure we never get into that. So effectively, the risk is in HOOPP, and so it's not in the employer. So that model actually, I think, is one that could work going forward for employers. So it gets around accounting issues. So I mean, it becomes acceptable to employers. So you can create something that looks a lot like a defined benefit plan, which is way better than, for most people are way better off in that type of structure than trying to do it on their own. And so, I think, if we can, so what we want to do is try to move people away, and the trend's been very much moving from traditional defined benefit plans to individual plans. And, I think unless something happens, that trend's going to be unstoppable.
Right.
And so I think we need to try and think about what solutions can we have that will work in today's world that are going to move things back in the other direction. And I think a structure like our plan is one that could work in the private sector. If you had the right public policy that allows that to happen.
Right. Some people, they don't have any access to target or defined benefit plans. So the question is what can public policy do for them?
Well, you can create these, again, so you create entities that run the pension plan. So I think the important thing is to move the management and obligation of the pension away from the employer to these third-party entities.
Okay, yes.
Which is what our structure is. And so if you look at Australia, that's effectively what they've done. So in Australia, all Australians have to be in a pension plan. Their structure is defined contribution. But I think you could take it one step further and make it look like our plan. And those entities are set up away from the employer. So each state has one. So there's a Victoria state plan, there's a New South Wales plan. So each state has one. Plus you can choose a private solution if you want to. And so there's a bunch of industry funds set up, and so you have to be in a fund. You pick the one you want to be in, and
Right.
so a portion of your paycheck every month goes into that fund, and the employer. In some cases matches, in some cases doesn't, but then it becomes pretty portable. Wherever you work, you can stay in that fund.
Right.
So portability is another drawback
Right.
in the current world to the traditional corporate DB plan, because people don't tend to stay in the same job their entire life, which used to be true, and so portability is an important factor as well. So having these third-party entities that are separate from the corporation alleviates that issue. The other issue that alleviates is that the life of the pension plan is very long. Right? So if it continues to roll forward, it's almost infinite. So we have liabilities current liabilities that go out 70, 80 years. Very few corporations survive 70, 80 years. So there's a mismatch between the life of the plan and the life of the corporation too. So, it's the traditional sort of idea that the corporation sponsors the plan doesn't work very well in today's world. So again, there's a bunch of things that I think our model deals with that are challenges in the current environment. So.
And can you talk to the generational issue that is what I would call baby boomers who are retiring now, Gen X, people like myself, and millennials who are coming, the types of things that you're talking about, who would benefit from them the most, and how do you deal with those different generations in terms of what they can expect to achieve?
Yeah, I think it's probably late to deal with the baby boom generation, because the baby boom generation is people like me that are entering retirement.
Right.
And so, if you haven't dealt with it, you should have dealt with it 20 or 30 years ago, but it's kind of too late for that. But, it's like the expression, when's the best time to plant a tree is 25 years ago, but the next best time is today. Right?
Right.
So, you can take the learnings from today and apply them to the next generations coming up, so they don't have the issue. And and I think, and a lot of the current generation actually were in DB plans, so it's not as acute an issue for the current group of retirees. It will be a problem for your generation, for example, and because a lot of, I'm sure a lot of you and your peers don't have defined benefit plans. But, if you start the process today, it's going to be a lot better than it would be otherwise. And it's not going to fix the current acute problem, but it certainly will. You can take those learnings and make it better for future generations. And if you don't fix it, you're going to have the problem, and the millennials are going to have the problem. And so I always think they should be the ones paying most attention to this, not the current generation, because it's going to affect them the most.
Well, we'll leave it there. Jim, it has been a pleasure to talk to you, and I really wish you well in your retirement.
Well, thanks, guys. It's been great talking to you today.
Thank you.